Oh, I've got the bell, so I think that means we need to start. Welcome everybody, and thank you all for coming, and thank you to everybody out there who's on the webinar. My name is Stephen Hungerford, and I'm the chair of the Disability Income Working Group. And also from the working group, we have Fei Zhang and Ronald Lai to discuss this topic today. Just want to briefly take you through the agenda for today. Just starting off with a brief background of the working group and just generally the industry as it is today. We'll then take you through the results of the 2 surveys which the working group has undertaken, and then from these surveys we'll give you the key takeaways that we think you can get from the surveys. At the end, we should have enough time for questions, but there is a lot of stuff to go through, so if you could please keep any questions you have until the end, that would be great. So the life insurance industry has been suffering from poor experience on disability income for a number of years now. In response to this, companies have been increasing premium rates, but in spite of this, the losses across the industry have continued and have been quite large. The Disability Working Group was established with the aim of identifying and educating the membership on the key issues which are driving the experience and on how to better manage this going forwards. To do this, the group is considering factors all across the value chain, including looking at the adequacy of underwriting, looking at product features, the appropriateness of pricing of those features, and the quality of the claims assessment. In addition to this, we are looking at other factors such as economic factors, and also in particular around mental health, around the increasing acceptance and diagnosis of this illness, and what its impact is on the claims experience. So to assist in this, the working group undertook 2 surveys to look at these and other factors. The first survey was sent to all appointed actuaries and asked for their view on product, pricing, and the experience of the industry. The second survey looked at changes to product, underwriting, and claims over time, and how that may have impacted on the experience of the industry. So to give it a context, these charts are based on the APRA Quarterly Life Insurance Performance Statistics. The chart on the left shows the net profit for individual disability income over the past 6 calendar years. Now, as you can see, since 2013, the industry has not made a product over a calendar year on this product. And in fact, no quarter has been positive since December 2015. The average loss over this period is around $376 million per annum. The second chart is the cumulative, average loss is $376 million per annum. The chart on the right shows the cumulative losses over this time period. Collectively, the industry has lost around $2 billion over this time period. And as you can see, last little while, there's been an acceleration in this as more companies have gone into loss recognition. Now, these charts include both direct insurers and reinsurers, but it does not include the financial impact of retrocessions. So as a result of this, these losses are probably materially understated across the industry. Now, as I mentioned, the industry has responded to this with price increases. This table shows the last few years the companies which have increased rates. The increases have typically been of the order of around 10%, and some of them have gone more than once. However, even with these, the losses are continuing, and as you saw from the previous graph, it even looks like they're accelerating. So with that context, I'd like to hand over to Ronald, who will take you through the results of the appointed actuary survey.
Thank you, Stephen. Good afternoon, everyone. So the appointed actuary survey, we thought the working group looked at what has been happening in the industry, particularly around the profitability. We know that every player is we all conscious about the sustainability of the product, and we thought, what can we do as a working group to as a profession to help the industry? And one thing we thought, it might be good to ask the appointed actuaries, given their role, what they do, and their experience, and what they see. So there are 4 main areas we asked the appointed actuaries. The first one is to ask them about their IP experience investigations, how often they do it, how detailed, things like that. And Then when it comes to product features, what have they seen? What changes have they seen to be made to products to manage the risk and to maintain the product sustainability? And then the other thing is the premiums, and you've seen the earlier slides already. Companies have definitely done something about their premium rates, and acknowledging, in particular, we asked them about whether they are seeing cross-subsidies and any long-term selection impacts. And then we also asked them pretty much any changes to any other areas that they think would be helpful in maintaining the product sustainability, either from a product perspective, from underwriting, claims management, regulations, and other things that might be at play. And I think it goes without saying that we thank the EY team to help us to collate and normalize the results. So first up, sorry, it's going to be a little bit difficult to read. Oh, yeah, so and I'll quickly run through the questions. So the first up we asked about the income protection experience, whether the company carry out a detailed income protection experience investigations. And as you would expect, everyone say yes. And then, okay, if given yes, how often? Most of them do a detailed investigations yearly. One of the respondents say they do it quarterly. And when you do them, do you investigate incidents and or terminations? And as you would expect they investigate both. And do they compare to the standard industry tables? And again, as you expect, they do. Now, then the second question is that do you consider the industry table, the ADIs 07 to 11, appropriate for pricing and valuation? And so we split them, itemized them, and I guess unsurprisingly, the answers are consistent. They do consider for pricing and valuation for both incidents and terminations. Most of them. And where they say no, it might be yeah. So and some of them actually said no, and further, and when we asked further on question 3, whether they actually adopted and adjust the table to the latest experienced industry results. Now, at the time of the survey, the latest result has not been published, so you see in the question it says 09 to 13. And also, do you adjust the tables to your own experience? So what is apparent here is that they all adjust to their own experience. They don't necessarily worry about adjusting to the latest experience because they adjust to their experience. And one is not adjusting. I haven't seen the result myself. My guess is that respondent may not be using the table itself, because they're doing their quarterly detailed investigations. And now, when it comes to rescaling the tables for the experience, you could see that different companies use different sorts of extensiveness of rescaling. And then if you do adjust, what do you adjust? And they would adjust both incidents and terminations. Question 5, we asked the appointed actuaries about what they've seen, whether they whether they have a view of how much claim experience have changed over the last 5 years and 10 years respectively. So over the last 5 years, most of them have said experience has moved by more than 20%. And 2 of them said, between 10 to 20. And unsurprisingly, when it comes to over the last 10 years, they all say the experience has moved by more than 20%. So just a quick recap. So it's no surprise there, no surprise there, no surprise here. And all adopt the ADI tables as a starting point except one, and various extensiveness of scaling. and there's no surprise there. And there's a quite clear message that the ADI tables, even with the latest results, are not up to date enough to reflect latest experience. So given the base that we all do detailed investigations to understand our results, we asked the appointed actuaries about what do they see to rank the drivers of experience in importance of up to 10. So you see there are a lot of drivers listed, and the last item being other, so we leave a space for them to give us more answers, because we can't be sure we've gone comprehensive. And it's worth noting that there's a couple of items down there that received no response. So almost every they've all been ranked within up to 10, so you could see the most important ones are ranked 1 to 2 in blue, and then 3 to 5 are important, and less important are in green. So to help get a clear message, let's remove the green bit. Then you could see what really stands out is the replacement ratios. That's very close to the heart of everyone, that it is a key driver to experience. Another one being called out, being really close to everybody's heart, is mental illness experience, the emerging experience. Then we move on to ask them, what about going forward? What do they see as the biggest threat going forward? And you could see, I'm not going to go through all the answers, read through all the answers. I've highlighted some keywords here. You could see mental illness being mentioned again. A couple of them talk about replacement ratios and replacement ratios again, and and then the generous product offering is an issue, which probably points back to increasing the replacement ratio inevitably anyway. And then they pretty much points back to the principle of insurability. And a couple of other things get called out as well. And this one I highlighted in red because, basically one of the respondents, if you like, show the frustration of, we know we have been trying, we want to do something. However, that's the first mover disadvantage. So the market lacks some circuit breaker, and so this is something for all of us to think about. What can we do as each individual player in the market? So so just quickly, replacement ratios, or moral hazard and insurability, and lack of circuit breakers are some of the key messages. Products. So what we started to ask the appointed actuaries, this one is about what they have seen being implemented in the market on the products. So you can see that limiting the benefit period and pricing in the expected claims of a trend, stricter definition, and introduction of wellness program received the most responses. And after this, we asked them, so basically they're saying it's a product becoming less generous, but not the most fundamental issue being cited earlier, being the replacement ratios or insurability. So we asked them, okay, the last question was about what have you seen, and you will see in none of the responses include reducing the replacement ratio, because the committee hasn't seen it ourselves, so we didn't. But we did leave an other in the response, but it wasn't in the other. But what they suggest to do going forward, you could see that remove limit agree value of the benefits, stricter definitions, and other. And what's covered in other is to lower the replacement ratios. So when the respondents give us the answer under other, they do tackle insurability is an issue, and the lack of ability to rationalize legacy products is cited under other as well, and also less generous products. Similarly, on premium rates, we asked the actuaries about to rank the effectiveness, and basically it all boiled down to you either increase the rates generally for overall claims experience, or you change the rates in different ways to reduce cross subsidies. Basically, if you go through the list here, they're pretty much different ways of different types of cross subsidies that are inherent in the products. And we asked a few more questions about premium rates. Are there cross subsidies? And they say yes, and if so, is this expected to continue? And interestingly, most of them also say yes, they expect cross subsidy to continue. This is a cross subsidy by the lump sum product to the IP product. The next question, do you believe long-term selection or anti-selection by policyholder exists? And you can see that most of them believe so. I think what we're saying here, do you see anti-selective lapses? And in generally, they're saying yes. If yes, are premium rates structure able to deal with the long-term selection? And so it's a bit more diverse there, the view. And but the blanks, two of the blanks are, they don't think there's issue, so they need to answer the next follow-up question. And then, do you consider policyholders' reasonable expectations are met with regards to the future age premium rates? And we've got a pretty diverse response there. So, in summary, mostly agree cross subsidies by lump sum, and there's existence of long-term selection. And views are more diverse on effectiveness of rate structure. And there appears to be little consensus on adequacy of age rates, which is a quite interesting point in itself, because a lot of the market players do benchmark their shape to the market. So this is a pretty interesting finding. And next up, we asked about sustainability from all sorts of different areas. Question 14, would more accurate reserving help better manage the sustainability? And this is a really interesting result. Most upon actually say no, more accurate reserving is not helpful. So this is quite intriguing. I'd really love to hear from anyone who has a view on that. And then 15, we asked about underwriting. What do they suggest in terms of underwriting to improve, to manage the risk? And you can see that more questions on psychosocial status and well-being is one. The other one is better financial underwriting. It's mentioned a few times under other. So these are the things they suggest we could do in underwriting, in terms of underwriting. And in terms of claims management, the standout one would be strengthening the rehab program, probably tied to the mental emergence of the mental illness experience. And then in terms of regulations, this is where we get quite a lot of responses under other in the comments, but allowing life insurers to provide health benefits insurance is one that stands out when it comes to regulations. Probably ties back to the claims management. and changes to advisors commission model. So yeah, so this is something else that, if you like, is outside of the company's control. Question 18, we asked them, if you like, all and cover all questions. Any other areas that you could think of? So we listed all the results here. You could see insurable interest, replacement ratios, more up-to-date tables, replacement ratio again, agreed value, which really just ties back to the issue of replacement ratio and insurability. And down there, the rating houses is cited as well, and product definition is mentioned as well. And the last question, pretty much a catch-all question. Any other thoughts you have? And you could see that it really comes back to the insurable interest or replacement ratio. And this one about being able to reset the benefit annually. So it's really just pointing back to the replacement ratio issue. And then advisors' interest rates are also cited, because it's true that most of the IP product being sold are long-term IP, so interest rates does have a pretty immediate impact to profitability. I'll stop it right there and then it over to Fei.
Thank you, Ronald. So in the next 20 minutes thereabout, I'll be taking you through the results from our underwriting and product survey. The survey was designed with the aim to understand or compare the changes over time for underwriting practice, both financials and medical. It also tried to compare the new business mix over a period of 8 years, from 2010 to 2018. And generally, we're asking them to provide stats as at 2010, 14, 18 for comparison. So 6 results at the end were returned back to EY to anonymize and collate. Whilst you sit back, every now and then I will be throwing a question at your directions, and really looking forward to hear your thoughts at the end of the presentation. So first thing, new business mix. Standalone versus linked. Although looking at the graph, it is not very clear that there is a reducing trend for standalone DRI. That's because out of the 5 respondents replied, not all of them fill in the information for every single data points. So if you look through at the underlying data, there's actually definitely appear to be a very clear reduction trend. Sometimes it's actually quite substantial, that over time people are selling less standalone policies. And I guess this is not surprising, given that the companies have been managing profitability through selling more linked policy, as we know that there is cross-subsidization between DRI and lump sum. Benefit period. So as you can see, the blue bar is going up. So there's definitely an increasing trend with a higher proportion of long-term benefit period being sold over the last 8 years, which obviously added more risk. Super versus ordinary. Again, if by 2018 you can see that there's a very sharp increase in the proportion of business sold through super. Perhaps given that the increasing unaffordability in DRI, customers are attracted to the 15% discount offered in the super just to manage cash flow. And also the super link type of structures are in place, introduced back in like 4 or 5 years ago, which definitely had an impact. At the moment, it is hard to say that whether the experience differ between O and S. I don't think there's any evidence suggests that they are different, but it will be interesting to monitor the experience over time, given that we have an increasing proportion of business in FundS. Step premium versus level premium. Again, the red bar is increasing, which suggests that the overall, the proportion of level business has been increasing over time, and perhaps being sold under the perception that premiums are more stable for level premium. And it is also possible that advisors are getting more cluey and they have worked out that the prices or the premiums are cheaper if you hold it for a longer period of time. Generally speaking, I would say level business are a riskier proposition because it is probably harder to change premium given the perception in the market that level, what does level mean to the customer? And again, it was to note that the profitability for level and step, the profitability for level business are more susceptible to the level of discount rates. And also to note, the generally speaking, in the base table, there's no differences between level versus step. All right. The next two questions about the proportion of new business sold through as agreed value, endorsed agreed value, and indemnity. And I thought it would be helpful just to summarize the differences between the three. I speak to multiple people whilst preparing for this summary, and I get different views. So this represents my own view. Generally speaking, at the point of sale, financials have to be provided for endorsed agreed value, but not necessarily for agreed value and indemnity. And at claims time, agreed value and endorsed agreed value pay 75% of your income at application. And for indemnity, it's about 75% for the income prior to disability. I personally think that there is a non-disclosure risk for agreed value, and hence the risk of replacement ratio being high for agreed value is higher than endorsed agreed value. But again, depends on the definition of agreed value and endorsed agreed value are different in the market, and your claim process are different, and hence whether it's more risky is subject to those variations. Okay, now I've set the scene. We asked what's the proportion of total new business sold is agreed value, and pretty much we can say that overall the industry sells more than 40% of business under agreed value, which is quite a lot. We also asked the question, what's the proportion of agreed value, endorsed agreed value is endorsed value, so the proportion of endorsed value. And most companies cannot split between the two, and the data is not available, which is not surprising. I think the general perception that the risks are the same between the two. And the other thing to note that generally speaking, there's no price differentials between the two. We also asked what's the proportion of self-employed contractor versus employed. It's interesting to note that there's only 3 insurers responded to the question out of 6, and perhaps it's not easy for them to identify self-employed versus employed. Overall, we sell more than 20% as self-employed. However, if you speak to a claim assessor, they're probably going to say that at claims time, the proportion of self-employed is much, much more than 20%. Again, to note that there's no rating factors in the base table, and there's no premium differentials generally in the market between the two. We also asked how many criteria do you use to assess disability? And by 2018, all insurer considers 3 of the criteria, which means that qualification for disability becomes more lenient over time. This is probably contradictory to a point that made in the AA survey, where the AA said that one of the things they have seen being implemented in the past to manage profitability is tightening the definition. So this is not one of them. Underwriting. We asked how many medical underwriting questions do you ask all applicants? And generally, the number has stayed quite stable, if not reducing slightly by 2018. And I guess it's not about how many questions you ask and whether you're asking smarter questions. The next one is quite interesting. We asked what's the maximum BMI threshold regarded as standard risk. For people who knows about BMI but don't know too well, the BMI of 18 to 25 are regarded as healthy, generally speaking. And to give you a more live example, in my current state, my BMI is 27, which is well below 31 and 35, which I was quite surprised when I calculated for myself. So you might think that BMI of 31 to 35 being regarded as standard risk is rather high. And by 2018, there's one insurer has increased to 36 plus, but there's one insurer reduced down to 26 to 30. And also interesting to note that BMI is a trigger point to decide whether medical tests are required. However, I thought it might be interesting to present the views from the underwriter why such a high BMIs are chosen. And the arguments are that the aim of standard risk is to capture 90% of the population. And in Australia, the latest stats suggest that 2/3 has a BMI over 25. And other arguments are BMI is not the sole indicator, so other things they take into account are financial, like your family histories, your blood pressures, and your cholesterol level. But do you agree with such a high BMI? Okay, so we asked, in addition to current salary and employment, do you consider other prior financial factors? And most insurers said yes, they do consider. And things that they consider are, historical financials, whether there are variabilities, whether you had multiple employment status changes, which will be a red flag for assessment. And others says employment status is required if it changed within the prior 2 years. We also asked whether they ask additional questions and process for self-employed occupation types. And we know self-employed are harder to underwrite for a couple of reasons. First of all, it's hard to determine the right level for them because how do you define personal exertion to your business? So generally, you'll find that at claims time, the self-employed might be overinsured. And we know that self-employed could be more risky because they go out, they run errands, they have an accident, and they're more likely to have mental illness because they're managing their own business. So lots of questions being put into place sort of to manage those risks. So people look at share of business, number of ownership structures, income trend, whether your business has commenced in the last 12 months. We know that business is likely to fail within the first couple of years. Look at your P&Ls and whether you've been bankrupted. What's the maximum monthly benefit for agreed value without financial evidence? I would suggest that it looks quite stable to me if you take into account CPI. But I think Stephen has a different view. And also it makes sense to see that the limit for professionals are higher than white collars and higher than blue collars. And I think the level sort of makes sense, doesn't seem too risky. Question 14, we asked them what's the maximum monthly benefit for indemnity without financial evidence. Probably from a financial risk point of view, it's not important what's the maximum benefit. However, if your max limit is too high, they might lead to a negative customer experience when it comes to claims time. So if we look at the max limit at 2019, I think A couple insurer had 20,000 as the limit, and others had 30,000, which seemed pretty high for me. Actually going to skip question 16 and 17 and happy for you to have a look at your own time. We also asked the question, what is the highest sum insured, large sum insured discount do you offer? If you look at the average on your right-hand side, you can see that it has been increasing over time, so we're offering higher discount to higher sum insured. And we also know that higher sum insured is more associated with professionals and with self-employed with a high income, and they also associate to have higher chance of becoming mentally ill. So whether we are adding more risk to our portfolio. Do you offer guarantee sum insured for professionals without financial underwriting? So generally, people offer guarantee sum insured to professions, especially to just graduated professionals, knowing that their salary will increase quite sharply over time. And it's interesting to see between 2010 to 2014, it is about 50-50%. However, by 2018, more insured are offering guaranteed discount, guarantee sum insured for professionals. We also asked them about lifestyle-related underwriting questions, such as alcohol, drugs, and pastimes. 4 out of 6 respondents said that they will apply loadings and exclusions based on the responses. All right, so question 20 to question 22, we're looking at the activities around reinsurance arrangement. So has the counterparty for your reinsurance arrangement changed over time, 2010 to 2013, 2014 to 17, and 2018? And we can see that there's actually a bit of activities between 2014 to 2018, and perhaps the insured are trying to manage profitability through better terms and conditions with a different reinsurer. And most people said that changing reinsurer drove a change in their underwriting approach. That's it for me. I'll hand over to our chair, Stephen.
I've been called worse things in the chair. So I don't know about you, but I think the results of the surveys provided some quite interesting insights. Some of the key takeaways which we've taken from this have been summarised on this slide. And I think the first one is very important. One thing that's really clear from this is that over time there has been an increase in risk introduced into this portfolio. We've seen relaxing of disability definitions. So for those who don't know, 1-tier definition started off as just the duties-based definitions. We've now added in the ability to work up to 10 hours before we reduce benefits, and also the ability to work and earn up to 20% of your income before we start reducing benefits. We're also seeing a reduction in underwriting questions. Now, some of this, as Faye said, relates to trying to ask smarter questions. In some cases, it's all around trying to simplify things for the customer. We've seen an increasing proportion of agreed value business. Now, it's unfortunate we don't have the data to see the split between endorsed and non-endorsed, but I would actually suspect that the biggest increase has been in agreed value that is not endorsed. We've also seen, relating to agreed value, an increasing proportion of self-employed people, which is just adding further to the risk. Again, as Faye said, we've seen increases in the large sum insured discount, so we're charging less now for the product for this increase in risk. And we've also seen increases in the maximum benefits which are offered without financial evidence. And lastly, we're also offering this to unhealthier people. We have gradually seen over time the increase in the BMI, which is considered as a standard risk within the portfolios. In addition to this, we have seen increases in level premiums. Now, this isn't necessarily a claims risk, but I guess it is impacting on the profitability of the business. Level premiums, like income protection, have been impacted by the reduction in interest rates that we've seen over time, and it just sort of compounds on top of it. Largely, I think the issues relate to a drift away from principles of insurability. You've got replacement ratios which now can easily exceed 100%, and a lot of the product features also offer benefits where there's not necessarily an insurable loss associated with it. And I guess the takeaway from this too is that these changes in risk over time necessitate more up-to-date experience investigations and also require a new industry table. So at this point we would normally take questions from the audience, and we're certainly happy to, but I'd actually like to turn this around a little bit and post some questions to the floor. The kind of questions I'd like to sort of hear responses to, if you could, are what you see as the key factors which are contributing to the experience of individual disability income. Do you think companies are actually on top of this experience, and are they pricing appropriately for it? Is the product that we are selling today even a product that can be priced? So many companies, when you're looking at your P&Ls, presenting your profit results, do comparisons against your best estimate. Often here where assumptions have been strengthened, says, oh look, we're performing quite well now against our assumptions, but not taking that into account. So I guess, should companies actually be comparing against the assumptions that were in place when that product was originally priced? Do companies really consider properly between their back books and their front books? You can change a product for new business, but there's very little you can do to your existing business. Big question is, the workplace now is very different to what it looked like 30 years ago when this product was first introduced. You now have workplaces which offer flexible working, you've got the gig economy, all of these things. Does the product adequately deal with these kind of things? And on top of this, you've also got the idea that 30 years ago you might have had one job for life, but now it's possible to have multiple careers over that time. And lastly, just a question around MOS reporting. A lot of the things what you've seen through those APRA results, the biggest losses occur in periods where the companies go into loss recognition. Are companies' experience of being allowed to deteriorate too much before it's having a major financial impact? So at this stage, I'd like to open to the floor for any questions or any thoughts on those questions.
Just while people are thinking about their answers or questions, I'm John McClanahan from the Institute. I just wanted to firstly thank Stephen and the Disability Insurance Working Group on the work they've done and the results of the surveys. But I just also wanted to make a point that the Institute is using this work to inform deeper discussions that are going to be undertaken by a special task force that's been set up under Ian Lachlan. It was advertised in this week's bulletin, and it will be advertised again in a more prominent position next Monday. But interested people who want to get involved in the work of that task force should respond to that bulletin article. Thanks.
Thank you, John. I guess while we're waiting for questions, I'll throw some to the two on the chairs. So I guess the first question, was there anything from either of the surveys that really surprised you?
I'm actually steal your thunder, Stephen. The one I actually mentioned earlier already, the fact that most upon actuaries don't think accurate reserving helps with the product sustainability. I thought that is quite intriguing. When thinking about the responses, I'm hypothesizing, I'm guessing maybe, well, no one upon actuary would have ever tried to understate the reserve. Yet, right, so if you go back in time, we would have tried to set the adequate, accurate reserves. However, year on year, you see experience keep, loss ratio keep pointing up. Meaning your past best estimate assumptions were actually not adequate. So I'm guessing that's why we're getting responses saying no. But in theory, I would say yes. If you could actually reserve adequately, it should flow back to the pricing team, to management, because it shows your profitability. And if you have really good analytics, it can even pinpoint what product features is costing you, and hence your management and pricing can do something, and product development can do something about it.
If I can, Anthony Bryan here. I've got a long history with this product as a reinsurer, direct writer, or a regulator, and now just looking at the outside. I guess the question is, what do you define as accurate reserving? Because every time we have ever valued the business and set a pricing basis, it's been out of date within the year. That we've always looked backwards to set our prices forward, and we've never got a nice clean line, because the factors driving the change are not things that are capturable just in the definition of the products and the variables. They are economic factors outside. So if you're saying if we actually understood what drove the product and could measure and analyse and correctly take those factors into account, wouldn't that be lovely if we had that much data? Then maybe that's what you call is accurate valuation, whereas I guess the appointed actuary is saying, well, if I'm going to value the liability accurately today, that's great. It's not going to be good for next month, but it's great now. And that's why they're saying it's not going to help, because the nature of the way you value the business and the things that are happening with it are evolving and changing, and the factors, no one saw this thing coming, and then no one saw that thing coming, the different things that have driven it. We didn't listen to what happened in the US when Unum came out many years ago. I can't remember which reinsurer brought them out. But yes, John Revere, a small life insurance company about the size of AMP, went under because of their DI business.
I guess that partly comes back down to that third question: is the product priceable if things are so variable? There was a question from the webinar. It says that mental illness is a hot topic with increased consumer awareness and perceived negative publicity for insurers. For example, the Victorian Equal Opportunity recently reported on the mental illness exclusions in travel. What are the learnings for the life industry, given it is a significant driver for disability income?
Well, I think the drivers of mental illness is quite well documented already. However, what I'd like to comment on is the fact that it actually comes out in the survey responses that we actually want to do something about it, because that's why some of the responses about suggested legislation change is to let insurer to do a better job in helping the claimants to, with their health issues. And yeah, so I think that is one important area that I would say the industry have a big, big interest for our customers to lobby the government about.
I've got a question. I'll ask it to the panel, but I'd be interested also to hear people's thoughts from the audience. It does seem that many of the key risks identified and losses have been happening for quite a while now. I guess, why do we think the industry has taken so long to do anything about it? It brought to mind, do you know what I mean by the boiled frog? Where you put a frog in boiling water, it will jump out. If you put a frog in cold water and gradually heat the water, supposedly the frog will just stay there and boil to death. But are we seeing the same thing happening with the industry?
I guess now that I'm not working for a particular company or the regulator, I can say that it's because everyone's chased the top line, not the bottom line. Everyone's chasing market share. And you've got that much cross-subsidies happening between lump sum and IP because you need to have a flagship IP product, or you're not going to have a distribution channel selling your product. And you have these funny things called rating houses, which say, let's rate a product and how easy it is for a claimant to make a successful claim. And we're all chasing to be top quartile in their measures. I used to tell companies when I was at APRA that I'm an actuary and I know you can't all be top quartile, it's impossible. But it didn't stop everyone aiming for it. But I guess the mental health thing's a little bit more challenging and interesting in that there's a more acceptance of it, and therefore you've got to look at a whole more new psychosocial, biopsychosocial factors and what are the stresses and things that are driving people's work. But we're also shooting ourselves in the foot because we're selling more and more business through superannuation. In order to pay a benefit out of superannuation, you must meet a condition of release, which means you cannot spend $1 on the person whilst they are in the waiting period. You have to wait till they've gone to the end of the waiting period and they're eligible for a benefit before you can spend any money on rehab. Assessments, yes. Rehab, no. Otherwise, you breach superannuation law. And so we need to be really careful about the fact that we're locking ourselves into 6-month waiting periods where we can't do anything in the way of intervention. And that's why there have been lobbying groups to the government to say we need to do something about this. Because a superannuation fund is not allowed to spend money on a member until they meet the condition of release, or let money out on behalf of the member until condition of release. And if you've got a 6-month waiting period, then they're entrenched disabled by the time you can get around and start spending money on getting them rehabbed because they're claims benefits. You can organise the rehab, but they have to pay for it themselves. We're not allowed to spend the money.
I'd agree too. I mean, perhaps companies haven't taken a great enough opportunity with the Superlink kind of benefits, because I mean, the introduction of Superlink was to allow for benefits which can't be paid through superannuation to be included within the product. But it's been mainly focused around adding all the bells and whistles.
How do you divide the premium between the superannuation and the non-superannuation premium?
That's not a question for here. So any questions from the audience? Yes.
Hi there, Matt Noyes. Thanks, really enjoyed the presentation. I wondered, when you were looking at the various different, various different product features, was there much concern about where features are offered as an option? So, for example, where you've got you go for a reduced waiting period, day one accident, or a more generous disability. Was there much feedback on where people had analysed their experience, perhaps by where people had actively selected an option, and whether that was worse?
Didn't ask specific for it. I don't recall it actually coming through. Correct me if I'm wrong. I think KPMG did show an increase in accident incidents, which could be related to the fact that you can now get these day 2, day 3 accident kind of benefits now.
It was a few years back that KPMG reported that back in the old days we said no short waiting periods for blue collar workers because they have a lot of accidents and they recover within a couple of weeks or a month or two. But blue collar workers with a 90-day waiting period and a day 1 accident option is effectively the same thing, and it was showing up as being a real horrible thing.
I'd just like to, I guess, my 2 cents about why it is so difficult to fix a problem in retail. Because compared to group business, there was a blow up in loss ratios, particularly for TBD business, go back about 5-6 years. And it was fair to say, in the group, the way the contract was structured, they were able to turn around quite quickly. And in retail, what the industry has been selling is this yearly renewable contract that the only thing the insurer could do is change the price or improve the terms. So you can't just say, I don't renew it, or and this is a really interesting point, because there you go, you have a big book of legacy products where once you started to realize it's in the red, you can't really do much about it. And I think that also goes why there may be a facade of companies chasing market share of new business. The fact is that you actually need new profitable business to subsidize your potentially loss-making in-force business. So you do need new business to hopefully to be able to turn it around. The one thing I would like to comment is I believe this long-term or indefinite term of business offering is not a given. We've boxed ourselves into this. We know that in general insurance, they all finish after 12 months. You just buy another new policies. So it comes down to community expectations. I understand that, and I would also accept that it is all fair for a pure life product to be a lifelong contract, i.e. death, because we haven't really seen the change in definition for death. Not very much anyway over the last 2,000 years. But for disability, the definition has changed over time, over the last, and particularly with advancement in technology and medical science. So I do see, personally, there's room for, and to add to the argument, when the government charges us stamp duty, they charge our disability product on GI stamp duty, right? So when it comes to community expectation, I believe personally it's possible to move our disability product to be a shorter term product.
So devil's advocate time again. First of all, if we are really writing new business, then why is the in-force business premium for a DI been the same or dropped slowly over the last 30 years? All we're doing is raping and pillaging each other's business. We're not writing new business. If we actually wrote new business as new business and replacement business without commissions, then we'd find a lot less twisting and a lot less of our legacy business would have really, really horrible experience, because it's only the healthy lives that move. You get left with the sick ones who can't get re-underwritten somewhere else. That Section 9A of the Life Act is the bit that defines continuous disability, and in Ronald's defence, it only says you have to have a guarantee for 3 years. You could change your definition of disability after 3 years, and so long as it's written into the original contract that that's the way you're doing it, you still meet the definition of being a continuous disability policy. You do not have to have a guarantee of a definition for life. But Section 9A(4) says if you're going to improve benefits or change premium rates, you have to get the policyholder's agreement in writing. And I'm not sure I've seen a life company do that in about 30 years. Back in the old days when I was at MLC, we'd do the premium rate change one half of the year and the benefit design change the other half of the year. So no client could ever claim that the premium rate change was due to the benefit rate change, and they wanted to refuse the benefit improvement and therefore not get the premium rate increase. So if you're doing them both at the same time, be careful that someone doesn't read the Life Act and give you a hard time.
Sort of back to your original point, I think the reason, I mean, you've seen sales across the market have probably dropped 20, 25%, and a lot of it I think is, I mean, there's less incentive now with the commissions, the greater focus of ASIC, everything else. I mean, that's another question. I mean, what impact is that going to have on this portfolio as well? Because you now don't have that as high an influx of new business moving, well, which essentially was replacement business from one company to another. Any other thoughts, questions, comments? No? Well, give you back half an hour in a day. Thank you all for attending. I'd like to thank Liz and her team at EY for helping to pull together these surveys and to pull together the results. Over on the table over there, there's a sheet to tear off so you can rate the session and put it into the box over there if you could. So thank you very much for coming.